Great. Well, welcome everyone. My name is Kirsten Loita of Osage University Partners. Although you may not have noticed it yet, it is almost officially summer, which means it is once again time for OUP's annual Financing Trends webinar, a discussion on startup financing trends to understand current market behaviors among startups. We welcome our partner institutions to this webinar. We view these webinars as a great opportunity for our partner institutions' technology transfer offices to ask questions in real time that they may have on startup financing trends for particular industry sectors. I'll now have our OUP panelists introduce themselves. Matt, do you want to start us off?
Yeah, sure. Hi, everyone. Matt Cohen, a partner with OUP. I'm an investor on the life science team.
Thanks, David.
And I'm David Dorsey. I'm a senior associate on the tech investment team.
Great. Thanks you guys for putting this together, and thanks to Margalit on our team for also working on the slides that we'll be presenting today. This year, we will again discuss general venture activity and investment trends specific to OUP's University Startup Network. The panelists will also discuss how COVID-19 has affected investing trends to date. The webinar will include a deep dive on each of the following topics. So of course, last year's trends, which sectors saw the most funding and active investors in 2019, COVID-19 trends, what has happened since the beginning of the COVID-19 pandemic in the venture economy, and what is the venture economic outlook over the next year, new funds that were recently announced and how much private capital is available right now. And then we're going to talk just a little bit about reliable investing trend resources that potentially you could follow to get more updates on this. There is no dedicated Q&A period during the webinar, so we just encourage you to ask questions whenever they come up. There is a Q&A feature on your toolbar, either at the top or the bottom of your screen, so please submit them there, and then I'll be asking them of our panelists as we go through the slides. The slides and a recording of this webinar will be available on OUP's partner portal, and a recording will also be publicly available via our YouTube channel once this is done. If you are logged into the portal, you'll find the downloadable presentation and so the deck for this, as well as the video on our webinars page, which is under the Startup Resources section on the OUP portal. So Matt is going to start us off in reviewing last year's life science investment trends. Matt?
Great. Yep. Thanks, Kirsten. Appreciate it. And again, I want to emphasize, would love for this to be a discussion as much as possible, given the large group. So please do submit questions. Kirsten will triage them. Will ask us those questions. Anything we don't get to, we'll try to answer offline as well, or could follow up with you directly. So even if it's something that we don't get to, we'll do our best to follow up and try to answer your question as well. All right. So we'll start with just a really overall life science investment trend. And where we pull this from is the Silicon Valley Bank 2020 annual report for healthcare investments and exits. Again, this is a wonderful resource, data rich, that is free to download. So you go to Silicon Valley Bank's website or just search Google for Silicon Valley Bank Healthcare Investments and Exits 2020 annual report. You have to put in a little bit of information, but it's totally free to download. And it's just really rich with stuff. So throughout this life science part of the talk for investment trends, we'll use some of this data because we think it's really some of the strongest data out there. And then we'll use a little bit of our own data that we garner from PitchBook. So, I think what you can see here really is that in the gray line that the number of deals have been increasing compared to prior years. And we've seen a somewhat steady increase of deals getting done within the life science group sector. This spans biopharma, health tech, diagnostics tools, and devices. That said, in the fourth quarter of last year, capital invested was slightly down compared to 2018, though we're still certainly surpassing 2017 numbers considerably. So, I think what we're seeing is a little bit of a leveling off in terms of dollars going into these companies, but clearly still robust interest in 2019 and really not much of a change. So we can perhaps just call this a bit of noise. And what you can see in the chart at the very bottom is that, again, biopharma continues to dominate as the predominant area for venture capital interest within life sciences, so therapeutics. But also, health tech is a pretty strong group, followed by diagnostic tools and devices. Let's go to the next slide, please. So what we decided to do was sort of dig in deeper into just to that biotech, biopharma area where most of the capital is being deployed, and just understand for the Osage University Partners University network what's actually happening. So what we did was we utilized our proprietary database of all the startups across our over 100 universities and pulled the data from PitchBook just for dollars going into those companies. And interestingly, what we see is really a steady trend upward. So when you look back to 2010, 2011, 2012, I want to caveat by saying that our network has grown considerably since then. So we don't have as much robust data. So some of this sort of vast increase has to do with just our network growth. But 2018, 2019, 2020, I think we've been pretty stable. And I think what we're seeing, at least early in 2020, within biotech and biopharma and therapeutics investing is not much of a drop off. And we'll come back to this when we talk about COVID impact on various sectors. But I think what we're seeing so far is a pretty robust amount of continued investment in the therapeutic sector in spite of COVID. We do perhaps see, go back one slide, please. So we do perhaps see that the number of financings in the first quarter were down compared to the first quarter of 2019, while capital invested was slightly up. So there's perhaps a trend here to begin to think about, in that investors are starting to overcapitalize or extra capitalize their investments in therapeutics. That may be a response to COVID-19 and a slowing of the economy, where investors want to be sure these companies don't need to raise capital at all in the near term. So by having them raise more now, we can ensure a longer runway. That may be a trend. Well, let's see how that plays out over the next few quarters. But I think it follows a general trend over the last couple of years of continued interest in these companies raising more money up front rather than small rounds, sort of stepwise as they go. Okay, thanks. For the next slide. So going back to some Silicon Valley Bank data, I think what we can see here is that over the last 3 years, oncology investing has dominated all other categories or therapeutic areas for biopharma. That certainly reflects our experience, and it reflects the deal flow that we've seen from all of our universities. I think that what's very interesting, though, is when you look over at the Series A financings and capital deployed, we've actually begun to see a little bit of a change. And so while oncology certainly dominated and was the largest group both in 2017 and 2018, we're starting to see what this category Silicon Valley Bank calls platform begin to take over in 2019. So actually the dollars into platform category in 2019 was greater than into oncology, although two fewer deals. And the way Silicon Valley Bank defines platform are companies that have yet to declare a lead program in any one particular therapeutic area. So I think it definitely supports continued investor interest in platform technology and technologies that can go into multiple therapeutic areas. And that said, all of these platforms ultimately get aimed at a certain place. And I think oncology will continue to be a very, very important place for these platforms to be aimed. So I think when you look at this data, I think just have in the back of your minds that doesn't mean these platforms have nothing to do with oncology. I think, again, platform and oncology, I think oncology will make up a big part of platform going forward. But these broad opportunities that can span lots of therapeutic areas, I think are garnering a lot of investor interest. Neurology continues to be a very important area, although it definitely backed off a bit in 2019 compared to 2018, whereas the orphan rare disease area sort of grew back to 2017 levels, all I think maybe within the realm of noise. And then I think the last category, which is interesting to look at, is an anti-infective. It'll be interesting to see how 2020 plays out. COVID-19 has brought a renewed interest in anti-infectives. Just the visibility amongst governments in particular may help push change for how anti-infectives get reimbursed and paid for, which was really the major headwinds for that category. But from 2017 to 2019, certainly a drop-off on Series A financings and anti-infectives from 320 million to 91 million. Clearly less interest in pouring money into early stage anti-infective companies over the last 3 years. And I'm really excited to see how 2020 might alter that, and where what areas of anti-infectives we might see additional interest, particularly vaccines and antivirals. Okay, we can keep going. So maybe to dive into some very specific areas that where we think there'll continue to be investor interest. I would say that largely similar between 2018 and 2019, and we think going forward in 2020 these areas will be some of the most critical things to look at. So certainly novel targets and platforms, and in particular targets with human genetic validation. I think more and more as we sequence more and more people around the globe, we learn more and more a lot about how human genetics influence human phenotypes amongst disease. And whenever you have a genetic mutation that you can believe manifests a particular phenotype, you can get a lot more confidence that drugging that genetic target or that target will benefit patients broadly. You also get a better handle on safety. So if you know a given mutation in a gene is generally well tolerated amongst the people, you might have more confidence knowing that drugging that target could generally be safe. Again, neurology continues to be an important area. And again, it comes back to human genetics. Investors who invest in neurosciences are very, very interested in ways they can address these diseases through a more human genetics approach. And even we were on a call just the other day with a major pharmaceutical company, one of the largest, and when they were talking about their neuroscience franchise and their areas of interest, human genetics within neuroscience, human genetically validated targets was one of the first things that was mentioned. Within rare and orphan disease, again, I think this again comes back to genetically defined diseases. So you can start to see a theme on the left-hand side around human genetics and phenotypes. I think you immediately capture investor interest when you can tell a story that involves human genetics. On the right side, oncology will continue to be an important area. There's a lot of big pharma interest in oncology, and that's driven by the opportunity to sell drugs in oncology. And quite frankly, revenue opportunities in oncology continue to be one of the greatest areas for continued growth. And there continues to be, I think, massive unmet needs in oncology. We've made tremendous strides over the last few years as we move into cell and gene therapy next, using CAR and TCR-based T cells. But there's a lot of room for growth, particularly in solid tumors. And then finally, autoimmunity continues to be, I think, an important area, and we continue to hear about growth and investor interest in this space. Antigen-specific immune tolerance. We've recently had an approval from Aimmune for peanut allergy, and I think we'll continue to see novel and new ways to address antigen-specific allergic-driven diseases. Regulatory T cell modulation, I think, is really important. I think now we have clinical proof of concept that infusing regulatory T cells can improve a number of different autoimmune diseases like graft versus host disease. But are there ways to modify those regulatory T cells endogenously within a patient, either using small molecules or antibody-based approaches, which might simplify the need to purify and infuse whole cells? And then finally, innate immune targets, like what people may have been hearing about lately, called the inflammasome. These are the NLR targets. We've had a number of companies pop up over the last few years targeting NLRP3, and that has led to several acquisitions amongst big pharma. And again, we continue to learn about and hear about big pharma interest in this pathway being a very important driver of diseases from the gut to systemic diseases to CNS-based autoimmune diseases, including neurodegeneration. On the bottom, we list two areas of what we call reduced excitement. I wouldn't say this means that they're areas that investors are not participating in, because they certainly are. I think we've just sort of seen a slowing and a more thoughtful approach to these two areas as investors invest money into therapeutics. So the first being immuno-oncology antibodies. I'll caveat that by saying, there's been actually a couple companies that have been venture-backed and launched in 2019 around novel immuno-oncology targets using antibodies. So that goes to say, these are still areas of investor interest, no doubt. But people are being more thoughtful about how combinations might work. There's been kind of sort of few successes with PD-1 combos and many high-profile failures with lots of competition. So people are just being thoughtful about how to advance novel targets and drug them within immuno-oncology. And then on the right, microbiome-based targets. Again, mechanism of action is a bit still poorly understood. There have been some failures in this space. And so people are, again, being cautious and thoughtful about the approach to going after unique microbiome targets. And it's an area that I think a few years ago, there was a ton of excitement around, and I think people are waiting to see how some of those initial approaches will play through and seeing what we can learn from them before we do, version 2.0 or version 3.0. So to dive into medical devices, number of medical device deals have certainly increased over the last few years. If you look all the way on the left, dollars being invested and deal number has gone up steadily over the last couple of years. So this is great news. In terms of Series A, though, if you look all the way to the right, a few categories have picked up, and the top one being imaging. The imaging category had 15 deals last year, $144 million in it. So I guess, this is an important area that I think all of us should be thinking about in terms of novel ways to image patients and how that might impact disease course and treatment. Then the other, I think, major areas like cardiovascular, orthopedic, neurology, and surgical have all been sort of the key areas for the last few years. I think the other thing to note is that while the number of Series A financings increased to 105, the capital raised within Series A financings has dropped back to 2017 levels. And so when you think about that, really the Series A deal size being of only $4 million really is 50% lower than 2018. So yes, a lot of deals are getting done, but tend to be smaller investments of roughly $4 million at Series A. And then I think the financing that are driving the increase in dollars and being invested really are being driven by later stage investors investing in later stage opportunities. Okay, next slide, please. To give you a flavor of the investors making these medical device investments, I know that's always a question we get a lot from, where can I go with my new technologies from my faculty who's investing in these early stage medical devices. The Series A investors, tend to be limited in terms of traditional venture capital investors, but groups like the Keiretsu Forum, which are, sophisticated angel investor cohorts, are certainly very active in this area. But a few others as well, like Aperture, historically have done a lot in this space. All the way at the bottom there, Lightstone Ventures is a group that does a lot in therapeutics, but also has some investments that they've made in devices as well. Corporates are certainly investors in this space. J&J is definitely willing to invest in the earlier stages. We've co-invested with them in a medical device company a couple of years ago at the Series A stage. And then, as mentioned earlier, crossover investors are certainly interested in medical devices, and names you'll know, like Deerfield and Perceptive Advisors, are there. Cormorant as well, that are historically doing a lot more therapeutics, are certainly happy to look at later stage device opportunities. And I think, as we'll see on the next slide, we're seeing an uptick in IPOs. So these later stage crossover investors are taking some of these later stage medical device companies public. One example of that might be Shockwave Medical, which went public in 2019. It was a fairly high profile medical device IPO. I want to direct your eyes to the left side and the bottom of the left side. And that's that the exit values have basically been increasing over the last few years, both on the M&A in terms of upfront payments and milestones, as well as IPO market caps. So, while the number of M&A and IPOs really didn't change from 2018 to 2019, maybe even slightly fewer M&As, there were 3 fewer M&As from 2018 to 2019, the value of all of those deals has increased, which is nice to see. And one of the things that might bring venture investors back to a space like this is the belief that one can make money. And so that has two sides of the coin. One is how much money you make, and 2 is how quickly can you make it. So I think we're starting to see a bit of a trend towards these deals producing attractive returns. So that's really great to see. Where we haven't yet seen a improvement on is time to exit. So I think we're still seeing, 6 to 8 years to get to an exit for medical devices versus therapeutics, which has a average time to exit of around 4 years. So I think it's good to see the first side of the coin start to increase. We'll continue to monitor this over time, but I think we'd also like to see renewed strategic interest in buying up these companies earlier. Let's go to the next slide, please. So moving to diagnostics and tools investments, really we've hit, frankly, an a 3-year low here with a slight increase in number of deals, but dollars being deployed in this category continue to go down. I'm very interested to see how 2020 will change with that. Again, COVID-19 being an infectious disease, diagnosis of that disease is highly critical, as we all know and have heard in the news. You know, testing is so important. So will be interesting to see renewed investments in diagnostic testing for infectious disease, and we'll see where that goes. But overall, I'd say we're starting to see diagnostic tests, coming up in 2018 to 2019 in terms of dollars deployed, from 200 million to 365 million. If you look on the right side there in the diagnostic test row in the middle. So let's see what happens in 2020, and will COVID drive that further. But overall, I think not as positive a story here as maybe what we're seeing on the device side. Next slide, please. And again, some of the investors interested in this area, venture capital groups on the left there, like North Pond, and again, you see Keiretsu Forum pop up again. But more traditional investors in therapeutics that you've seen, or even some more traditional tech investors like Data Collective are popping up, being interested in diagnostics and research tools. Several corporate investors are interested in this space. And then all the way on the right, again, there is a group of corporate and later stage investors who are interested. A few, like Kajan and Viking, were Series A focused, particularly on the tool side, less on the diagnostic side. But most of the rest of the list were focused, again, on later stage investment opportunities. And several high profile IPOs last year, I think were really helpful to see, like Adaptive Biotechnologies, for example. Going. Yeah, and again, to that point here, IPOs, in 2019 really drove a lot of the exit value. I mentioned Adaptive. 10x Genomics was another really big IPO that had, again, over a $2 billion market cap, driving a ton of the value here on the IPO side. So, limited number of companies exiting, but a few really, really high valued ones. So for us, when we look for these opportunities, you're really looking for the game changer kinds of technologies, which 10x absolutely was in the single cell genomics category, and Adaptive in the TCR sequencing category. But really outside of 2017, M&A exit values really were the lowest they've been in about 6 years. So again, it's a tough space to invest in, ultimately make money in. But what most investors are looking for are really those game changers, those technologies that will truly move the needle. And those can get financed, particularly at the early stage. But there aren't, I'd say, a lot of those out there. Okay, let's keep going. Great. So at this point, we've kind of gone through the life science data for last year, and we'll come back and talk more about life sciences in terms of COVID-19 impact in a few slides. But in the meantime, let's turn it over to David to take us through tech investing trends.
Great. Thanks, Matt. So the first slide here is just we would like to do a recap of the sort of capital invested and the deal count over the years. And it's important to remember that last year when we gave the financing trends for tech activity, 2018 was a massive jump from 2017. And it was unclear what was going to happen from then on, whether this was the new normal. Valuations are going up, the size of the rounds are going up, the number of deals were going up as well. But the number of first financings were all going down. And so what you see here is, 2019 is down in terms of capital invested. The number of deals is actually flat in this area. So let me first say something about the categories of companies that are in this mix here. This is not consumer facing. This is not large, mining operations, things like that. This is software, semiconductors. This is some of it is healthcare technology, like platforms for collecting data. So it's it's tech in this sort of broad sense, and we'll talk more about sectors and which ones are like clearly being affected more than others in this. So just talking about from 2018 to 2019, you know, VCs invested 124 billion in non-life science deals. That's a 13% decrease from 2018. And the number of smaller financings, the angel seed deals, that trend has continued to decline. Same as from 2017 to 2018, that there is still a decline. And part of the reason has to do with some other factors in the early stage VC dynamics, and we'll talk about that in another slide. So this is all investments. This is not just university investments. So, you know, I would say, you know, 2018 to 2019, there was definitely a drop in tech deals, but not in the number of them. And later on, you'll understand why, like some of the later stage deal sizes have gotten smaller. And so that's one of the reasons for this as well. And there are definitely some sectors that have been impacted versus others. And we'll talk about that as well. So just to talk about kind of the deal size, the deals by size, that's the bottom chart there. You know, the 0 to 500K is the one that we talk to a lot with university spin-outs. So we see an early stage company and it's looking to raise its first $500,000. And there are a lot of ways that it can raise that money. It can get it through grants, non-dilutive capital. It can get it through incubators. It can get it through other kinds of programs that the universities create. But as far as VC capital at this stage, it's very difficult, and it's trending down more and more every year, and it has been since 2014. So the 500K to about $1 million is also gotten smaller in 2019 from 2018, probably more so than any other year. Seed deals continue to get bigger, and so when you look at the 1 to 5 million. That is still the biggest chunk there, and that is actually mostly that's seed deals, you know, that have gotten larger and larger. So this doesn't break it down by the type of round, but what used to be a Series A is now a seed, and what you also see here is from the 5 to 9, and then as you go up to 10 to 24 and up to 25, what you're starting to see is that from 2018 to 2019. There's a shrinking at these like 25 million and above rounds, which is it's not tremendous, but it's worth noting. We go to the next slide. And so here we're sort of talking about these early stage deals in a little more detail. So the number of first financings, which is what we really care about when we're talking about a lot of the early stage university technologies. We care about first financings, and they continue to trend downward, but the deals are getting bigger and bigger. So that there's two lines here. One of them is the dark orange line, and one is a lighter yellow. And the orange line is the angel deals, which have stayed relatively consistent over the years. But they've gone up from 2015. In 2015, they reached their maximum, and they're starting to sort of taper off. Seed deals were up at a maximum somewhere around 2014. And they have since also come down to the number of deals being around the same as the angel investors. But the difference here is that, you know, the blue is the dark blue and the light blue. That's the capital invested. And so these seed deals are getting bigger. The angel deals are too. If you look at 2019, the blue angel deal value is also up significantly from 2018. Whereas actually, it looks like the seed deal value is what took a hit from 2018 to 2019. That actually is less capital that's been invested. So part of this is that companies, and we talked about this last year, companies are operating longer than before without VC capital, just because there's so many other mechanisms for getting their first 500K, their first $1 million through incubators and accelerators. And right now, the median age of companies that are raising their very first VC round in the tech landscape is about 3.3 years. That's up from last year, which was at an all-time high. So these companies are going a very long time without ever speaking to or getting a term sheet from an actual VC. They're getting it from all kinds of other sources. And that's probably a good thing. Like a lot of this is non-dilutive capital, which is really helpful for the company to grow. Some of these incubators and accelerators, especially some of the ones that are connected with universities, are really high quality and provide companies with an opportunity to get themselves to a higher valuation when they actually do get a term sheet, and they can suffer less dilution. They know how to pitch better. Their product market fit is established. And so it's an overall, I think, good thing for the startups that we look at. Again, you'd like to see seed round capital being the seed round capital that's invested going up or increasing for these early stage deals. But the fact is the number of deals continue to go down, and investors still favor Series A and beyond. Series A is still like sort of the sweet spot for most investors in the tech space. You can go to the next slide. So we'll look a little bit about sectors, and we're going to look at more detail for that too. So first of all, this is always the case that software makes up almost, it makes up the majority of the investment in the tech space. It accounted for almost 48% of all the VC deals in 2019. That's $55 billion. But that's down from $72 billion in 2018. So there has been a drop from 2018 to 2019 in the capital invested, right? But if you look at the sector, actually, the sector that took the biggest hit, it seems like here from this data, is software. So a lot, and I don't know exactly why that is. Some of it could be that there is a over investment in this space. A lot of companies that are doing things in big data and AI, ML, and really haven't panned out, haven't found product market fit, haven't been able to make traction. And so the number of deals have decreased, and also the amount of capital that's been invested in software has decreased. And you even see a little bit of expansion, not much, in some of the other sort of less exciting investor spaces, like semiconductors and computer hardware and chemicals and gases and things like that, and text. Like there have been other sectors now that are either receiving about the same amount of capital or proportionately more in terms of the overall capital. But it's worth noting that software has taken the biggest decrease in this dynamic. The seed round size is decreasing, but the median deal sizes decreasing from 2018 for later VC rounds is new. So this is one of the trends that keeps going up, and we don't know where it's going to go. If you look at the top blue line, it kind of goes through cycles here, where the median late VC deal seems to be going up and continues to go up, and it's gone down more significantly than it has in any of the previous years listed on this chart. And I don't know if that's an ongoing trend or not. The fact that it's going down in the time of COVID with all these other kind of uncertainties in the marketplace may mean that this is a trend that's going to continue, but it's just unclear. Right now, midway through the year, almost midway through the year, the median deal size for 2020 so far is down from 10 to 8.5. But again, that's really early data, so we don't know where this trend's going to go. But in terms of the other ones, the early stage VCs, the seed and the angels are staying flat, but the seed and early VC, the round sizes for the deals that they're doing continues to increase. So the overall capital deployed is less, but the size of the rounds is gradually increasing, and the trend continues steadily. We can go to the next one. So I want to dig down more into specific verticals in tech, and I apologize, some of the text here is small, but I'll try to walk through this. So this map is basically, each one of the boxes reflects a vertical in VC, and so these verticals, it could be that some companies could be big data and fintech. So they don't represent one unique specific company. These are verticals that the company's going after. And I try to find the primary vertical that best describes what the company is going after, but some of them will have multiple. But the size of the square is the amount of capital that was invested in 2019 in this vertical, right? So it gives a sense of the overall, like how much capital is going into that specific vertical. And the color of the box is the year-over-year change from 2018 to 2019. So you saw a decrease in capital invested from 2018 to 2019, but like where is that? Where are the losses and where are the gains? And so big data raised in 2019 about $10.8 billion, and applications of AI/ML $9.7 billion. But that's down a little bit, about 12% from the previous year. So look at the ones that have seen, and it's down in fintech. It's down a little bit in cybersecurity. I would say that's almost flat. Cloud and DevOps is down. Like these are really popular software areas of investment, right? And then the growth is coming from $1.3 billion in supply chain tech, mobile commerce, real estate tech was up. It's only a $767 million investable market. And some of these are smaller, but like robotics and drones, these are hardware, clean tech, supply chain tech. And so like, it's clear that a lot of the capital, I mean, it's not necessarily perfect data. Some of this, like I said, might be big data and supply chain tech. But traditionally AI/ML has been going up every year. And so to see this going down and sort of see where the capital is going instead is interesting, I think, from 2018 to 2019. And with COVID, it'll be interesting to see, what some of the new winners are and losers because of the new dynamics. The big data investments to continue to increase from 2018 to 2019. Later on, we talk about kind of quarter over quarter from 2019 to 2020. You'll see that the dynamics are changing a little bit in these big sectors of big data and AI/ML. We'll go to the next slide. Matt, I think we're going back to you now for these slides.
Matt, we also have a question too, but I think actually you may be answering this question. So let's go through the trends since COVID-19.
Yeah, great. So the data we pulled, and I know there's a question about diagnostics. The question was, have we seen any evidence for an increase in investment in diagnostics so far in 2020? And would we anticipate that potentially continuing for the next few quarters or next few years? I'll say we have not yet pulled that data. Diagnostics investing tends to be a small category. So when you look at it, within each quarter, it tends to be small numbers. We can go back and look at that data and can get back to you on any hard specific data. I can say anecdotally that I've seen a lot more diagnostic, especially related to infectious disease or viral diagnostics pitches. I've seen a lot of companies pivoting their business model to address the current pandemic. I can't say that I've seen data that supports that they're actually getting investor dollars. So let us go back and look and see what the data shows so far. What we did do is we wanted to look at what has happened to a very large category for venture investors, which is biotech and pharmaceuticals, and what have we seen over the first couple quarters of 2020. And I think what's fairly exciting is that in terms of dollars deployed, we've seen more capital deployed than any quarter since the second quarter of 2018 already in 2020. So there's a couple things to think about. One is a number of these deals were probably in the works before COVID-19 hit the US. So some of these deals, could be reflecting a bit of a lag. I think also, though, we're seeing maybe a drop off in number of deals in the second quarter. Now, there's always a reporting lag, and the second quarter isn't done yet. But I think what's exciting here, and the overall takeaway is biotech and pharma investing, at least for the first couple quarters of 2020, continues to be very robust. Next slide, please. And I think we can attribute that increase in dollars invested to later stage financings. So if you look at the left chart, seed in green, Series A in yellow, and Series B in black, there's been a spike in Series B financings and private capital raised. And again, this goes back to something I said earlier, which is companies are looking to capitalize themselves very, very well, and maybe over-capitalize themselves because they want to basically be able to push through any potential downturn in the economy or investors pulling back. And again, in biotech and pharma, the currency, our main currency is data generation. It's not sales, it's not revenue, it's data generation. So if you raise enough and you can generate that data, you now have the currency to raise more capital. And if you look on the right, the number of financings by round, I think, it's largely flat relative to the last couple of years. So, I mean, maybe we're starting to see a slight downtick in second quarter, but again, there's a data reporting lag for this quarter, and we're not done this quarter yet. But clearly dollars going in are going up, and a lot of that seems to be driven by the later stage, whereas, seed and A tends to be, or looks to be relatively flat, relative to prior quarters. Next slide, please. Great. David, you want to take us through tech investments?
Sure. Yeah. So, and this is an overall trend that we covered, I think, in the earlier slides. Just is that the amount of capital being raised in 2019 and Q1 2020 year over year is in decline. We don't know what Q2 is going to look like. I suspect it's probably going to be along the same lines, but 2019 was down from a really big 2018. So you have to take that into consideration. The number of deals done is still relatively the same. So it's not as bad as this slumping chart looks, but I think it's still like, we have to be careful. We have to be cautious. And I think that there's a lot of uncertainty right now around tech investments, with COVID and what's going on. We'll go to the next slide, maybe talk about some individual sectors that are likely to be impacted. Some of this is from our own kind of anecdotal evidence where we're talking to startups that are getting interest from VCs. And some of this is, reading analyst reports and also, using some intuition here. So, first off, we do see a lot of interest and a lot of discussion around cybersecurity and InfoSec from customers and also from investors that are deeply looking at this space. I mean, the number of endpoints that have been added to most, enterprise networks when people are working at home creates a lot of new attack vectors. And so information security, breaches, network and cloud security are really important. And so are things like network performance. So companies that provide those kinds of services and products are also going to be worth looking at. So there was like COVID-19. I don't know if some of you have seen this, but I've seen this in my own inbox. The number of phishing attacks grew over 600% from February to March. That's according to KnowBe4 and Barracuda Networks research. I don't know why that is, but I guess maybe because a lot of people are working from home, but there are a lot of phishing attacks that are being initiated right now because of COVID. Another one that we've seen is supply chain, and I would add to this kind of manufacturing in general. Disruptions in the supply chain, especially for US manufacturers, some of whom are outsourcing their manufacturing to somewhere else. These disruptions in the market are highlighting the need for the ways that they need to ensure business continuity and mitigate impacts when there's new economic shocks like this. And so they're looking for ways to shore up their infrastructure, make it more robust against these kinds of shocks, and also thinking about whether or not they need to move some of their manufacturing and supply chain operations, closer into the US, or to make it more diverse so that they have a more redundant and robust supply chains. And there are lots of software companies that provide better visibility across their delivery and supply chains. There's a lot of automation technology here. So I think in manufacturing kind of supply chain, you're going to start seeing some interesting dynamics. This is a small market, but I think it's worth talking about. Like, we have seen an uptick in food tech because of the continued margin pressure on restaurant delivery services. And, a lot of them are losing money. And so you see a lot of automation, automated delivery, services are famous, but also the rise of ghost kitchens, where you just have these kind of brick and mortar kitchens somewhere in a dense urban place that makes takeout food, but it has no customer service. So no customers actually go in. We've seen robotics startups come out of universities that are making robotics that automatically make things like sandwiches and salads and put them in a little bag for Grubhub delivery. And so I think these are going to see increased investment. I don't know how much, but it's definitely something that COVID is going to have an impact. Telehealth startups, anything that's also helping employees work from home. There's been some mental health support apps that we've seen that have gotten financing or are still getting financing right now in COVID at relatively high premiums. So anything that's offering support for at home, some of it is even sort of at home diagnostic kits, I think, are also getting interest. But definitely we have seen this kind of call center support workers, people who are doing sales. There's a lot of kind of healthcare and wellness services for that are receiving more investment right now.
And if I can add in that area, I think it's key to know that one of the barriers to this historically have been state laws, where it's been difficult to administer care between states. And there's been a huge groundswell of support now to lower those barriers and make changes there. And I think it's starting to trickle through at the government levels as well. So I think just some of the regulatory barriers that were in place, hopefully will come down, hopefully in smart ways. And that will, I think, greatly enable the ability to deliver telehealth in a more efficient way.
Yeah, thank you. Yeah, and then, like mobility tech is going to suffer. I mean, at least in the short term, things like Uber and Lime and electronic vehicles and autonomous vehicle startups are facing significant challenges. That's what we're seeing so far. They're having difficulty raising. That may not always be true. There may be some instances where for delivery and for freight, autonomous freight and things like that, you may see some investments. But I think on the whole, mobility tech is going to have some struggles here. And then lastly, I'll just say, like fintech, I think digital payments are probably going to see an uptick just because of the increase in e-commerce, but also because of this kind of new contact averse world is probably creating new habits in consumers. We'll go to the next slide, and we're going to talk about changes in the tech verticals from Q1 2019 to Q1 2020. And we were talking a little about this before with 2018 to 2019. I got rid of the AI, ML, and the big data blocks because they're big and you can't see the rest of the little markets here. But they're both down, Q1 19, Q1 20. So you're starting to see, again, some of these big investment spaces in software are down, AI, ML minus 28%, big data is down 47%. Remember, that was the big blue square in the 2018 to 2019 chart. And if you look cloud and DevOps, back-end architecture for, creating apps and, running businesses is up 39%. I just said this thing about mobility tech, and look, they're up 77%. Clean tech was up, mobile commerce was up, gaming is up. Advanced manufacturing took a big hit. That's not a huge market. So it's interesting. Fintech stayed about the same. It's still a big player in the space. But again, the big drop at AI, ML and an increase in things like mobility tech and cloud DevOps is worth noting from Q1 19 to Q1 2020. And then this is, this reflects a kind of pre-COVID world. Still, I think a lot of them, these investments were done before the threat of COVID was looming. And so the next slide, we're going to talk, this is very preliminary data because Q2 is not really done yet. Q2 ends in June 30. And so this is just looking at the Q2, it says Q1 19 to Q2 20, but it's actually Q2 19 to Q2 20 and the change over the year for these quarters. It looks down across the board. Now, again, some of these may actually come up at, when we get all the data in. Some of them, though, are significantly down. And so I don't know that they'll make, if they'll come up, it may not be as severe as this. Mobility tech that was really up in the last one looks down, probably for the reasons that we discussed. And the things that are already up from, without receiving all the data is manufacturing, e-commerce, HR tech, things for like home, supporting workers from home, esports, because we're just playing video games all day, B2B payments, which makes sense. So So these are the ones that are already beating their Q2 last year. And I think that's worth, looking at. There is definitely some effects. COVID is providing tailwinds for some verticals and not others. And so it'll be interesting to see what this data looks like in a month, and whether or not these verticals that are down stay down. But I think this is interesting preliminary data.
It definitely is, David. I just wanted to jump in here really quickly because we had a question on, what about the differences between, what you've shown so far on these, both the life science and tech verticals, for that, considering, a lot, obviously our audience are working with academic technologies, which tend to be even more high risk areas. Are investors changing their practices, investing in more high risk technologies, or are they kind of stepping back and saying, okay, these are things actually that have already had reduced risk, and that's where we're going to put our dollars right now?
Yeah, I could say a couple of things on that. I'll go take the life science perspective, and biotech pharma, again, being the highest category. I actually disagree with the premise that investors in biotech and pharma won't take risk at the early stage. I think there's been a massive amount of capital that's been raised to be invested in early stage academic biotech spinouts. And we're seeing hundreds of millions of dollars, billions of dollars deployed in that area. So, I often believe, and this is my personal belief, that early stage biotech doesn't struggle to raise money at the early stages because it hasn't been necessarily de-risked enough, but it often comes down to the idea, quite frankly, and the best ideas, I truly believe, are getting funding, and it's not due to a lack of early stage risk capital for those funding those best ideas. They are getting funded. That said, there is a belief out there that perhaps valuations could come down for later stage opportunities due to the global financial markets. If that's the case, as an investor, when I start to think about, do I want to invest in a highly risky opportunity early versus a later stage, less risky opportunity where the valuation has now become very attractive due to the global economy, I do then start to think, maybe I should deploy more capital at the later stage because I can get some really good deals for less risky opportunities. I think that possibility could happen. That said, and hopefully we'll get to a couple slides, there's been a lot of capital raised over the last couple of years for early stage biotech, including this year. And so I don't see these companies taking big discounts to allow later stage investors in at cheap prices. I think there's more than enough capital to support them at current valuations, if not higher.
Great, that's helpful.
And then quickly, we just have a slide here actually inspired by Bruce Booth, one of the managing partners at Atlas Venture, and his blog. And he put up some data, and we've modified this data slightly and done a little bit of our own analysis. But this data comes from PitchBook, and it just shows, what happened in past crises. How are these different areas impacted? And I think what's interesting to see is during the Great Recession of the 2008 to 2009, again, biotech and pharma was not greatly impacted in terms of private capital that was raised in that area. And again, most of the interesting biotech pharma deals do come from academia, for sure. And we didn't see a huge impact there. It was pretty flat. Whereas, for tech, absolutely an impact, a decrease in private capital raise, but of course rebounded. And if you set this graph out further, rebounded in massive ways where, I think, we're looking at $15-16 billion deployed over the last couple of years per year. So, minor blips, and it's hard to compare the Great Recession to COVID. It's totally different types of potential recessions. But I think this is promising for biotech and pharma, and requires some thoughtfulness with regards to tech. So again, just quickly some observations because we want to get to a couple other things. But I think the life science deal flow and pace remains pretty steady. The tech team has seen some dynamics, and we give you 3 examples here where we've seen evidence of corporate strategics pulling back from deals where we had a strategic investor who was going to participate, who suddenly stopped doing all new investments. We're seeing increases in insider-led financings especially for tech companies, and also for life science companies. We're seeing this because companies want to try to put off doing larger raises, and they can't necessarily raise at higher valuations right now. And then for a tech company, one of our portfolio companies, the lead investor decided to add some more investor-friendly terms to a deal once the COVID crisis really started ramping up. And so instead, the company basically rejected that offer and opted to do an inside-led round instead. And I think overall, we're still early. We've only gone through, the first 2 quarters, really not even 2 quarters yet of this. And so the second half of this year, I think, will be really, really telling. One hypothesis might be that new co-creation could slow, because a lot of the things that were already in the works pre-COVID, one was able to continue spinning out and building. But how do you create new co's with faculty when no one can meet face to face? That might be harder. It's harder to build relationships. So we'll see, right? As things play through, we'll see if there's any impact like around new co formation. Okay. Next slide. So we don't have much time, so I just want to put this up so that you all see, and we'll make the slides available. But lots of money announced in 2020, fresh new funds amongst high-profile investors, a lot of big dollars here, both life science and tech. Next slide, please. And again, there's plenty of capital available in 2020. This is the cumulative overhang of dollars that have not been invested amongst venture capital. And you can see, we're sitting at an all-time high right now of dollars that are within that overhang that is ready there to be deployed and invested. And as many of you know, venture capital funds have strict time requirements around investing that capital. Our funds are 5 years investment periods, so that money does need to be invested over the next several years. Next slide. Okay, so we wanted to get to some resources for everyone so that you have additional places you can go to learn more about trends in investing, both life science and tech. And one fun one that we wanted to throw out there is Twitter. So if you're not on Twitter, or you're sort of reject the idea of being on social media, if you can make a Twitter account and follow a limited set of people, it can actually be really valuable for hearing about what high-profile industry folks or venture capitalists think about different sectors. So one example was Jorge Conde from Andreessen and Jared Friedman from Y Combinator put up an alternative model for doing biotech company formation. They published this, and in response, Bruce Booth tweeted out and wrote an article on his blog, basically responding to should biotech be more like tech, and it created some interesting discussion here. And Twitter was one place you could have learned about that back and forth. If you go to the next slide, it's funny, but Bruce and Jorge have a great relationship, but you get to see some maybe light trolling or some Twitter feuds here, where Jorge posted about their investment in a company called Teammunity out of UPenn, and the potential for CAR T to deliver a cure for cancer. Now, that said, that was in October of 2019, and we know CAR T curing cancer is something we've known about for many years earlier than that. And so Bruce kind of jabbed at him for writing a blog about how great this new CAR T thing is, even though traditional biotech VCs have been investing in it for years, where Jorge's more of a tech investor. And they kind of had a fun back and forth, ribbing each other a little bit. But these are the kinds of things you get to see, these real-time conversations, if you're on Twitter. And ultimately, you can see at the very end, Bruce congratulating Jorge for the new fund that Andreessen raised for their life science investment strategy. And of course, saying looking forward to co-investing. So, while these folks can all disagree, and you get to see those disagreements in real time about the way they think about investing in biotech, it's a small community and everyone's friends and like to work together.
And by the way, I'll also add, if you're interested in seeing fun jokes poking at the indefatigable hubris of tech VCs, you can just follow Matt Cohen, because his Twitter feed is just filled with it.
Very good. Thanks, David.
So we are getting close to the end. I would like you to go over the resources, but while you're going over these, I just want to point out to those of you who are still left on, we do have a survey that we'd love for you to answer. It's in your chat box right now. It's very short. I think it's 5 or 6 questions. It'll be super fast for you to answer. Matt, back to you. And I have one more question for you guys too.
Sure. So again, if you decide to sign up for Twitter and create an account, we listed 5 Twitter accounts to follow. These are all biotech related ones, but feel free to just email David Dorsey and he'll tell you about all the tech ones to follow. And then blogs and web news. We mentioned Bruce blog from Atlas. Jared Friedman from Y Combinator has a great blog. There's web news like Fierce Biotech. There's several podcasts that are quite good, although I know podcast listenership is way down since none of us are traveling much. And then email newsletters. Endpoints News is a great one for life sciences. And then Term Sheet by Lucinda Chen, powered by Fortune, is a really good one that covers predominantly tech, but also some life sciences as well.
Great. So we are over time already. I really appreciate everyone taking the time. I'll let people read over unless there's something particular you want to take on these takeaways. I know you've talked about each of these. We do have one other question, which was talking about investing in COVID technologies, particularly out of academia, and what you've seen in those areas so far. Is there an uptick in investment, obviously, in these COVID-19 technologies, or what are you seeing?
Yeah, great question. And actually a similar question was posed by Oren Herskowitz on a discussion he posted up on Columbia's site around that he did with one of my partners, Bill Harrington, and another VC from Benrock. And that question was raised. And it's an interesting one to think about. It's going to probably be a big market and a big opportunity. That said, at least our fund is not investing in COVID-related technologies right now. We view that there's been a lot of capital deployed from very large players, not necessarily VCs, but very large companies, to try to improve on the current COVID crises, vaccines, therapeutics, and diagnostics. And so the large companies are deploying massive amounts of dollars to address the issue. And quite frankly, we'd have to see some incredible game-changing technology that no one else could replicate to even have the beginnings of an interest in doing something in COVID. And also, I think the general belief is that, COVID-19 won't be around forever. We're going to hopefully solve it. I think everyone feels, a lot of positivity towards solving it. And so once it is solved, what does it mean? So all that said, I just want to stop and say we have seen companies be very creative in how they're using the COVID-19 crisis to improve themselves. So, for example, one of our therapeutics companies that was about to do a clinical trial for patients with idiopathic pulmonary fibrosis had to stop. They weren't going to be able to do that trial at all. But their drug mechanism of action could apply to COVID-19. And so they decided to, and they are doing a COVID-19 clinical trial. What's the value in doing that? Is it to make a COVID-19 therapeutic? Perhaps. If it works, it'd be great. I personally don't believe it has a very high probability of success, but I also don't believe that's why they're doing it. They're doing the trial also because one, it could help patients, but two, they're going to get some really, really interesting data around pharmacodynamic biomarkers that will tell them a lot about the drug they're delivering at the doses they're giving it and what it's doing to the biology. And that information and that learning will help them design a better clinical trial when they can start doing clinical trials for idiopathic pulmonary fibrosis patients. So yes, it's a shot at potentially helping COVID-19 patients. There's not a lot of options for those patients, and we should throw whatever we can possibly at it. But even if it's not successful, which would be unfortunate, there's still valuable information to be gained for this company. So I think that kind of creativity in sort of this time of difficulty when it comes to enrolling clinical trials is important, and one approach to sort of not investing directly in COVID-19 technologies, but investing in the opportunity that COVID-19 presented itself to have for this particular company.
Thanks, Matt. David, do you have any final thoughts you'd like to share? Now that we are over time.
Yeah, we're out of time. I'll just say, like the slide says here, there's still lots of capital available. If you're a tech startup, you kind of want to rethink your value proposition and ask yourself if the problem that you're solving is a must-have, if it's supporting some of the new problems that have cropped up because of COVID and some of the new dynamics that have been created. And it could be an opportunity actually for some of the technologies that have seen less investment in the past, the sectors that have not seen as much attention, to really start to see, show a real value add in enterprise and in industry, and start getting some more investor dollars as well.
Great. Well, David, Matt, thank you so much for reviewing these slides with us today, going over these investment trends, especially obviously in light of the pandemic. People are really obviously have a lot of questions about what is happening. I think this was a good overview of what you're seeing so far. But as you said, second half of this year may tell us even more. As our attendees can see on this page, if you do have further questions, please feel free to reach out to Matt and David with any further questions. Thank you both again for your time today. Thank you to our audience for spending the time with us, and we wish you a good rest of your day. Take care.
Bye. Thank you.
Thank you. Bye.